webinar, you will learn, by the end of this webinar, you will be able to explore the importance of credit scores and reports. Learn how to access information about credit scores and reports. Discuss strategies to build and improve credit. Identify how to protect credit from incorrect claims and fraud. Your credit can have a big effect on your financial life. Your credit report provides a snapshot of your financial habits that financial institutions, cell phone companies, credit card companies, and other companies use to get a sense of your credit worthiness. Understanding how credit scores and reports work can help you keep your finances healthy and help you achieve your financial goals, such as buying a home, leasing a car, or paying debt. How well do you know your credit score? How well do you know your credit score? I know it, some people say I know it exactly. I have a rough idea. I don't know it at all. I don't know what a credit score is. So we will answer all those questions for you today. Before we get into why credit scores are important, let's discuss what they actually are. A credit score is a three-digit rating that tells a lender how likely you are to repay debt. Different lenders use different criteria to calculate it, but in general, the data is grouped into five categories, including payment history, amount owed, length of credit, and new credit, and credit mix. Poor credit is less than 579. People who have a score of 579 or below could probably use help to rebuild their credit history. Fair credit between 580 and 669. In this range, it may be difficult to qualify for loans. If you get a loan, it may have high interest. Good credit is between 670 and 739. If your credit score is between 660 and 740, you may have blemishes on your credit report and you might be restricted to higher than average interest rates on loans. Very good credit is between 740 and 799. A credit score between 740 and 799 is very good. You will qualify for most loans and you probably have a solid credit history. Exceptional credit is above 800. If your credit is above 800, you have the strongest credit history and qualify for the best loan terms and interest rates. Your credit score can be poor to exceptional, but what if you don't have any credit at all? Many people, especially young people, have no credit history. It's not a bad thing. It's not the same as having bad credit or poor credit. Although people without credit history may face similar difficulties in getting loans or proving their credit worthiness. However, there are many steps you can take to start building credit. And in step one, open a line of credit. This could be a credit card through a bank or retail store, or a small loan that you can repay on time and in full. Step two, request that your payment history be reported. If you pay your rent and utilities on time, you can request that your landlord or your utility company report your positive payment history to credit bureaus. However, you have to remember that your landlord or utility company is not required to do so, even if you ask. And step three, open a joint account. You may request a family member or friend with good credit to co-sign on a loan or a credit application. But remember that your actions will also affect their credit. And step four, Pay all your bills on time and in full. Never miss a payment. If you think you are about to miss a payment, contact your creditors and see if there are any options available. But how does your credit score affect your daily life and your ability to achieve your financial goals? Let's take a look. We're going to look at a scenario. There are two friends, Anna and Bella, who both want to get a home loan. Anna and Bella have been friends since middle school. They are both single and both have steady incomes and pay their bills. Anna and Bella decided to buy homes in their childhood neighborhood. Bella receives a loan without any trouble. Unfortunately, Anna has a little difficulty time getting a loan. When she finally gets her loan approved, her interest rate and insurance premiums are higher than her friends. So why do you think that's her interest rates are higher? Now that you know Anna and Bella's story, let's see if we can figure out the details. Credit scores are not the only factors that lenders consider. Factors such as the market, down payment amounts, loan terms, and lender loan policies can influence the cost of a loan. Still, experts and research shows that one's credit score has a large effect on the cost of a loan. As you've seen, credit scores can affect your ability to get a loan, as well as your interest rates and insurance rates, but they also can affect your eligibility for a rental home. And as many homeowners and property managers check your credit score before renting to an unknown person. Your credit scores can have an impact on many areas of your life, such as getting a car, setting up utilities and phone service. Essentially, any person or any organization that you are seeking credit from may review your credit report to ensure that they're lending to a responsible borrower. So much depends on the three-digit score. Who actually comes up with this three-digit score? Let's take a look. There are many agencies that prepare credit scores, and they can use different models to calculate them. However, most popular scoring models are FICO and Vantage Score. There are three main credit bureaus in the United States: Experian, Equifax, and TransUnion. They, along with lenders, use their own version of FICO or Vantage Score credit scoring models. Credit scores may also be different depending on the financial product you are applying for. For an example, mortgage applications may yield a different score for you than if you were applying for a credit card. What do you think is the most important factor in determining what your credit score is? Is it the amount owed, payment history, payment types of credit, and new credit or length of credit? As we mentioned earlier, different credit bureaus calculate credit scores differently. While the bureaus do not disclose exactly the method or formulas they use to calculate your score, we do know the general factors they consider. The most important factors that affect your score are your payment history and the amount of debt you owe. So let's take a closer look at these factors and others that make up your credit score. Payment history. Payment history typically accounts for approximately 35% of your credit score. This primarily includes looking at whether or not you pay your bills on time. Do you always pay at least the minimum amount? If you do, then you're in good shape. If you make even one late payment, it will likely have a negative impact. That's why it's so important that you always pay your bills on time and pay at least the minimum amount when you do so. Amounts owed. Amounts owed typically accounts for approximately 30% of your credit score. The amount you owe depends on two major factors: how much you actually owe on your credit card or loans. Owing money doesn't necessarily mean you're a risk to lenders. The most important thing is showing that you make regular on-time payments towards your debt. Length of credit history. Length of credit history typically accounts for about 15% of your credit score. Credit history is affected by how long you've been managing credit. The longer your credit history, the more information a lender has about your repayment habits and reliability. And then there's new credit. New credit typically accounts for about 10% of your credit score. New credit or credit that you've recently applied for accounts for a smaller part of your credit. Each time you apply for new credit, a lender runs a credit check. And types of credit. Finally, types of credit typically accounts for approximately 10% of your score. People with a mix of credit types like credit cards, auto loans, and a mortgage may have a higher score than those who only have one type of credit. Credit scores are extremely complex, and your actions and everyday decisions can influence your finances. We're going to pause here for just a moment and we're going to watch a short video on credit utilization. Okay, give us just a moment. Video coming.
Hello, everyone. Welcome to Green Path's Money Bites. Real questions and bite-sized answers. Let's dive right in today. We're staying on the topic of credit. Katie from West Virginia sent us another question. What's your question, Katie?
I've heard that 30% of my credit scores are based on my utilization with credit, but I'm not exactly sure what that means. Can you explain that to me?
Thanks, Katie. It seems like this part of your credit can be really confusing, Maurice. Can you tell us a little bit more about how to look at our credit utilization?
Yes, Donna, and thank you for that great question, Katie. This part of your credit score can be a bit confusing, and we want to try to clear up that today. Your credit utilization accounts for the second largest factor of your credit bureau calculation of your scores. To put it simply, credit utilization is how much you currently owe divided by the credit limit.
Okay, makes sense.
Generally, you want to keep your credit utilization lower than 30% of your credit limit.
Okay.
For example, if you have a credit card with a $1,000 balance or limit, you want to keep that balance at $300 or lower. The higher your utilization, the more likely that lender would hesitate to approve you for more credit.
Got it.
If you did get approved, you probably would face interest rates that are high, and you're going to have some difficult time getting out of debt.
This is interesting, and it really clears up a lot of confusion. Other than keeping your utilization rate under 30%, what other tips could help?
Yeah, we have a few more. We're going to keep it in threes.
Okay.
So first one today, make small purchases on your cards. Pay off the balance in full right after you make that purchase. Number two, set a balance alert.
I love that tip.
Yes. Some credit accounts allow you to preset a certain balance limit, and that will alert you once you've reached that balance. This helps you stay on budget and avoid spending more than what you want.
Sure.
Pay on your credit cards more than once a month. This way, you're using your credit card throughout the month, but also paying in the middle or latter part of the month, and keeping your credit utilization in that 30% or lower threshold.
These are great tips. And I hope this helped address your question, Katie. Thank you, Maurice, and to those tuning in. Don't forget to visit our website, greenpath.org, for more information on credit, our services, and to access our credit worksheet.
Money Bites.
Okay, thank Green Path for that great video. Okay, now we're going to talk about the effects of co-signing and merging credit. Many people think co-signing on a loan is helpful. It's a helpful action to take, especially when you're co-signing on a loan for your child, significant other, parent, or close friend. Similarly, many married couples or people in long-term relationships decide to merge their finances. It's important to know how this decision may affect your own credit score. Let's look at a few scenarios on how co-signing, merging finances, and sharing lines of credit can affect your credit score. Okay, we're going to use Anna and Bella again. Anna just bought a new house, but it is further away from work than her old apartment. She needs a new way to get to work. She would like to purchase a new car. She has taken some steps to improve her credit and is now eligible for a loan. Anna wants to use the loan to get a new car, but she has a little problem. She needs someone to co-sign. Should her best friend Bella co-sign on a loan with Anna? Why do you think she should co-sign, or why not? While co-signing on a loan may not necessarily impact Bella's credit score, the loan will appear on her credit report. There is no right or wrong answer here, but Bella's credit will be impacted negatively if Anna does not pay her loan on time. When you co-sign on a loan, you are promising to repay a loan if the other person does not do so. If Anna pays off her loan on time, it could actually help improve both Anna and Bella's credit score. If she does not repay the loan or she misses payments, it will affect both of their credit scores negatively. Applying for credit on your own or with someone else can affect your credit score. Be mindful of your own credit score before making the decision to co-sign or loan or merge accounts with someone else. Adding an authorized signer or user to your credit card is also a common way to share credit. But keep in mind that the primary cardholder is responsible for paying the bills. If you both use the card responsibly, it can increase both of your credit scores. However, adding an authorized user can be a risk for the primary cardholder if the authorized user overspends. We've talked a lot about credit scores, but what about credit reports? Are they different? Your credit report is a snapshot of your credit profile, including your history. Every time you take out a personal loan or apply for a credit card, those actions will appear on your credit report. It's important to review your credit report regularly. It's one of the tools to build and maintain a good credit. The three nationwide credit reporting bureaus calculate your credit score based on the factors that affect it. Many people wrongly assume that checking their credit score or report will affect their credit score negatively. That is not true. In fact, keeping an eye on your credit report can help you in many ways. It can help you detect fraud and maintain or work towards a better credit score. You can get one free credit report from each of the three credit bureaus per year, online or by phone. To get your free annual credit report, you can go to annual credit report at annualcreditreports.com, which is the only website that is federally authorized to give you your credit report for free. The Federal Trade Commission maintains it. You can also request your credit report for free via telephone. And that phone number is 1-877-322-8228. And if you go to page 3 in your participants guide, getting your free credit report, all of that information will be listed for you. Because you can only request your Equifax experience and your TransUnion credit report for free once a year, think about spacing out your request to maintain an eye on your credit report every 4 months. There are other instances when you can access and get another copy, an additional copy of your free credit report. Does anybody know what those other instances are? And if you're thinking in case of fraud being reported on your credit report, if you're thinking if they need to apply, if you need to apply for some kind of government assistance, or if you are denied credit, you can also get a free copy of your credit report. You are entitled to one extra free credit report under certain circumstances to verify the information: fraud, denial of credit, and unemployment. Now that we know more about credit reports, let's find out how to get credit scores. Credit scores, unlike your credit history, are not currently included in the federal credit reports available. You can get your credit score by requesting it from various companies, including the different credit bureaus. These credit scores used to be available only if someone such as your potential lender paid for them. Now scores may be available for free from a number of different credit monitoring websites. Using these services allow you to check your credit score whenever you want to, while monitoring your progress in between your annual checks of all your reports. Your credit report will contain 4 major sections. Review each section thoroughly for accuracy. Make a note of any inaccuracies or unknown or suspicious details. There are 4 major sections in your credit report that you should be aware of: your personal information, public records, credit accounts, and credit inquiries. There are some information that won't be included, such as your medical information, information about religion, race, or sex, information about your checking and savings accounts, and information about any debt or prepaid cards. Private loans you've received from benefactors or friends or family, those will not be included in your credit report. Experian, TransUnion, and Equifax also offer sample credit reports on their website. Requesting and reviewing the information on your credit report is the first step towards maintaining and building healthy credit. What are some of the important things to look for? It's important for you to review your credit report regularly to make sure the information is accurate and up to date. Your credit report contains information about your credit history and how well you manage debt. It can also be affected by public records such as bankruptcies, unpaid debt or bills, or how much of your available credit you are using. Most of these types of information can remain on your credit report for up to 7 years. Bankruptcies can remain on your credit report for up to 10 years. And certain tax liens can remain on your credit report indefinitely if not paid off. Look at the following dates carefully. Date your account was opened, date of delinquency. If you have noticed any errors, you must dispute these errors with the credit bureau. Review your credit report thoroughly. It's a good practice. If you come across information that is incorrect or fraudulent, you can take action. There are some steps you can take if you need to dispute items on your credit report. The first step you can take is you can write a letter to the credit reporting agency. Tell the credit reporting agency what item you think is inaccurate. When writing your letter, make sure to include all of the documents that support your position. The letter should include your name, address, copies of the item in question, and copies of your credit report with the item in question circled. Send your letter by certified mail and request a return receipt. Law By law, credit reporting agencies must investigate the items in question unless they consider your dispute frivolous. Sending the letter by certified mail with a return receipt ensures they will receive your letter. Wait for your results in writing. When the investigation is complete, the credit reporting agency must give you results in writing, along with a free copy of your credit report if the dispute results in a change. And the third thing you can do is send a letter to the information provider. The information provider is the person, company, or organization that provides information about you to a credit reporting agency. Make sure you let them know that you dispute an item on your report as well. Include the same information, your credit report, a list of the disputed item, and a clear statement of your reason. Include copies, not originals, of any documents that support your request for correction. Mail this request via of certified mail and request a return receipt to ensure that it has been received. Fixing incorrect information is an important reason for reviewing and checking your credit report regularly. But what happens if you have experienced an unexpected life event, such as loss of a job, an expensive medical issue, or a divorce, and you find yourself in debt? If you've been through an unexpected life event, there are steps you can take to reestablish your credit. They are very similar to how you establish credit. Step one is monitor your credit report and scores. Step two is pay your bills on time and regularly. Nothing builds credit faster than regular and consistent payments. Step three, get credit counseling. Not-for-profit agencies advise people about money and debt management, help create financial plans, and offer workshops. Step four, Consider financial products as discussed. Getting a secured loan or a credit card can build your credit. However, there may be trade-offs, such as fees or minimum deposits amounts that you should understand and ask the financial institution about before applying. The Credit Repair Organizations Act helps protect your rights, including preventing credit repair organizations from engaging in deceptive practices such as false advertising that can cause you harm. In other words, credit repair organizations may not overpromise, for an example, to delete all bad credit, regardless of whether it is a legitimate debt that you have accrued. Also, credit repair services cannot demand advance payment, must put contracts in writing, and must offer consumers contract cancellation rights. Next, we will learn how to identify potential scams from credit report companies. Let's turn to Anna and Bella. She is trying to rebuild her credit, but is having trouble keeping up with her credit card payments. She she researched several credit repair companies. Let's see if we can help her recognize the good ones from the bad ones. If you turn to page 3 in your participants guide, you'll see credit repair scams. Anna is trying to rebuild her credit, but is having trouble keeping up with her credit card payment. Anna researches several credit repair companies. The first company promises to remove all bad credit from her report. She has to do, all she has to do is pay an upfront fee. Anna is worried about her bad debts, but the company assures her that it can scrub all negative information from her report. The company also advised Anna that not to contact the credit bureau directly, since doing so will negatively affect the company's efforts. How many red flags did you hear in that scenario? Okay, red flags include that the agency promises to remove all bad credit, that they are asking for a fee, and they are asking for a fee up front before they do any work. They advise her not to contact the credit bureau directly, and that they say they can scrub all negative information from her report. The company that Anna found in research promised to remove all bad credit information from her credit report and required her to pay fees to remove all bad credit notes from her report. Should she do this? Should she sign up? Should she do this? What do you think? Anna should not do this. She should not trust the company's promise to remove all bad credit notes from her credit report for an upfront fee. According to the Federal Credit Repair Organization Act, credit repair companies must successfully remove the credit inaccuracies from an individual's report and provide proof that the report has been changed before they can request payment for services. It can take up to 6 months. That's a red flag. Analysts should also be suspicious of any company that promises or guarantees to remove all bad credit information. That's a red flag. Analysts should not pay anyone fees upfront or before the services have been delivered. Analysts should not trust any company that promises to remove negative credit information that is legitimate. Credit repair companies can only remove negative credit information if it is incorrect or a result of fraud. If a company requires you to claim that accurate negative information on your credit report is false, that is a red flag too. Analysts should not trust any company that recommends or advises against contacting the credit bureau. That's also a red flag. There were a lot of red flags in this scenario. To recap, there are many red flags you can spot in a credit repair scam. They include the following: requiring upfront fees for a credit repair service, promising to remove all negative credit information from your report, offering to scrub or alter legitimate credit information, and instructing you to not contact the credit bureau directly. You are entitled to dispute errors for free, and it is your legal right to do so. Asking for a signature on blank paperwork, credit profile number scams, fake social security number scams. There are a lot of scams out there, so you have to be very careful. Credit repair companies can help you spot and remove incorrect or fraudulent information on your credit report. Credit counseling agencies can also help you improve your credit. If your credit report is poor, you may consider taking advantage of credit counseling services. Many agencies offer a free initial session. These agencies may help you create a financial plan to decrease your debt. If you want to follow along in your participants guide, you can turn to page 5, My Debt Management Plan. And this is a plan that you can use for your own debt, and you can take it with you and create and include, fill it out and include your information at your leisure. If you choose to use credit counseling agencies, look for agencies that is accredited with either a National Foundation for Credit Counseling or the Financial Coaching Association of America. Look for services such as better money management techniques, debt reduction strategies, and financial plan development, and get information about their services and possible fees before paying anything or providing private information. We covered a lot of things that could potentially affect your credit. The good news is a few good habits and strategies around managing your credit and debt can go a long way towards helping keep your credit score high. Here are some basic strategies to help you. Use your available credit wisely. Use less than 30% of your average available credit and do not max out your credit cards. Pay your bills on time. Pay off your credit card bills each month in full if possible. Doing so shows agencies that you are responsible and lowers the total amount of money you owe. Pay off your loans on time. Not only does defaulting on your debt cost you fees, but it also will quickly damage your credit score. Do not apply for several credit accounts in a short period of time, and make a financial plan or a debt management plan to reduce debt. Create and follow a monthly budget. Periodically review your credit report for accuracies. Being mindful of your spending and monitoring your credit are good habits to develop when building and maintaining credit. Your credit score is something that can affect your entire financial life. Some, so make sure to take good care of it. A good credit score can help you achieve more of your financial dreams. If you have bad or poor credit, don't be discouraged. Keep track of your credit reports on a regular basis and adopt responsible credit habits so your credit score can be as high as possible. It can be an uphill battle and may seem like it's taking a long time, but making small changes now can help have a big payoff. So thank you so much for attending our financial literacy today.